To quote John D. Rockefeller, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Banks aren't merely storage for money, they're crucial components of the economy. They influence our daily lives and the wider economy. Buckle up as we unravel the inner workings of banks. At its core, a bank is a place to store money. You deposit your money, and the bank keeps it safe. Banks are not just glorified vaults holding onto your hard-earned cash. They do much more. They ensure the safety of your wealth, facilitate transactions, and provide loans. Think of your money as a flock of sheep. You can't leave them in the open, exposed to the elements and predators. Banks serve as the shepherd, offering a secure refuge for your money, defending it from theft or loss. But banks are not static storerooms. They're active hubs, akin to the heart of the economy, pumping blood, or in this instance, money, around the body. They facilitate transactions, allowing you the convenience of paying for daily necessities or that new gadget you've been eyeing. Without banks, these everyday transactions would be complex. Banks also function like benevolent relatives, always willing to assist when needed. Aspiring to buy a house, initiate a business, or embark on a college journey, banks are there to grant loans, making these significant decisions possible. They examine your financial standing, your ability to repay the loan, and if everything checks out, they approve the loan. However, banks are not charities, they are businesses. They pay salaries, maintain infrastructure, and satisfy shareholders. So you might wonder, if banks disperse loans and secure our money, how do they generate profits? But how does a bank make money? Let's dive deeper. Banks, like any business, are here to make a profit. Their methods, however, are somewhat complex. You lodge your cash in a bank for security. Your deposit, along with others, creates a fund. The bank doesn't let this money idle, ITISes it. Banks offer loans to individuals and businesses from this fund, charging them interest. This interest is a primary profit source. Banks don't loan out all their cash. They retain a fragment of total deposits, known as fractional reserve banking. Let's understand this better. If a bank has a 10% reserve requirement and you deposit $100, the bank can lend out $90 and keep 10 in reserve. The borrower then deposits the $90 back into a bank. This process repeats, creating a multiplier effect. Hence, banks seem to create money out of nothing. But this system relies on trust. Trust that depositors won't all withdraw, trust that borrowers will repay. If that trust is lost, can the system collapse? That's a story for another time. For now, let's respect the genius of this profit-earning system. It's an intricate dance of numbers and trust, a delicate balancing act of lending and holding back. This might seem like a simple operation, but it's a delicate balancing act. Banks are not without their risks, but fear not, there are safeguards in place. Every financial institution has potential risks, like a bank run. This scenario happens when many customers, out of fear, try to withdraw their funds, thinking the bank might collapse. This can be compared to a game of musical chairs. When the music stops, not all will have a seat. In a bank run, the bank might not have sufficient instant cash to pay each depositor, leading to panic and eventual collapse. But let's not just yet, we have several safeguards to prevent such a disaster. For instance, the United States has the Federal Deposit Insurance Corporation, or FDIC. The FDIC was set up in the 1930s during the Great Depression to provide deposit insurance, assuring the safety of depositors' accounts in member banks up to a particular limit. Essentially, the FDIC acts as a safety net, ensuring that depositors will not lose their money if the bank fails. Picture it like wearing a safety harness while walking a tightrope. If you slip, you won't fall. Moreover, banks are required to keep a certain level of reserves. This reserve serves as a shield against unforeseen circumstances. Additionally, are regularly audited and scrutinized by regulatory bodies. Watchdogs ensure that banks follow the rules and avoid unnecessary risks. So, while banks have inherent risks, these are counterbalanced by a strong system of safeguards. These measures offer protection to both banks and depositors. They instill confidence in us to trust banks with our hard-earned money. Banking, then, is a system of trust underpinned by these safeguards. Fast forward to today, and banks have evolved beyond the basic deposit and loan system. The modern banking landscape is a vibrant hive of financial activity. Traditional institutions coexist with innovative fintech startups, moving beyond their initial boundaries. Banks have now delved into investment banking, acting as intermediaries, to help businesses raise capital through issuing stocks and bonds. They also participate in trading activities, purchasing and selling securities for their clients and themselves. Banks have also made advancements in asset management. They now handle vast portfolios of assets on behalf of individuals, corporations, and governments. Their objective is to increase these assets over time, generating wealth for their clients and a substantial fee for themselves. The advent of fintech has significantly reshaped banking. Banks have digitized their services, offering everything from online banking to mobile payment apps. They're using data to analyze risk, customize products, and enhance customer service. This revolution is redefining the way we perceive and interact with money. But the changes aren't limited to new services. Banks are also re-evaluating their primary functions. They are using technology to make lending more accessible and efficient. They are investigating new methods to protect deposits using advanced cybersecurity and blockchain-based solutions. They even show interest in cryptocurrencies, acknowledging their potential to transform the financial sector. Indeed, banks have morphed into multifaceted financial entities, adapting to a rapidly changing environment with innovation and agility. They are leading economic development, shaping our financial future while securing their own. So, the world of banking is a complex but fascinating one. As we progress, it will be intriguing to see how this landscape continues to evolve and adapt. As we've seen, banks play a crucial role in our economy and daily lives. They're not just money storage facilities, but integral parts of our economy's machinery. They facilitate transactions, safeguard our money, and keep commerce thriving. We've explored how banks function, accepting deposits, lending money, and fueling wealth circulation. They also earn through loan interest and financial services. We've examined how they balance risks and stability, and how regulatory bodies offer a safety net to banks and their customers. We've looked at how digital platforms are traditional banking. But as we look into the future, one question remains: how will the role of banks change in the increasingly digital world we live in? We invite you to share your thoughts in the comments below.